Hi, this is Jim Cunningham. I've got Christina Orta with me and Chris Spence, and we're going to take a deeper dive into oil and gas investments. No pun intended, I guess. This is not legal advice. It's not financial advice. It's not advice on the oil and gas industry or anything. This is purely information only. So, don't watch this and go do a bunch of stuff thinking you got a bunch of advice. It's a bad idea. If you're watching this on YouTube, we're doing this live. We do these live every week. And if you're watching this on YouTube, go ahead and hit the subscribe button. And also the little bell, it'll alert you to videos as they come out. We're based in California. We have clients in many states of the country. And we have these attorneys are devoted solely to trust and estate matters. And we do a lot of income tax planning, and there's a lot of income tax strategy kind of baked into the oil and gas industry, being a subsidized industry from the US government. I'm the CEO and partner Cunningham Legal. I've got over 25 years experience, and we have offices throughout California, as you saw. And we help clients in Missouri, Texas, Virginia, Washington, and the state of Washington, the District of Columbia. And I'm a certified specialist, real estate broker, securities insurance licensed, and a instrument rated pilot. So a lot of stuff, but we have here two really wonderful people that I just love working with. We've got Christina Orta. She's at Ascent Wealth Management. She is a certified financial planner. So she is the kind of person you would talk to if you watch this and you go, wow, this sounds interesting. I'd like to learn more. I'd like to take the next step. Christina is the one that you would take that step with. Chris Spence is with Mewbourne Oil, and he's the one out there with his roper boots and his cowboy hat, looking for oil and getting it out of the ground and getting it to the refiner. So that's what they do. And I will, with that, Chris and Christina, the two Chris's. Oh, I forgot my book. You can order my book, Savvy Estate Planning. It's on our website, 2nd edition, super exciting stuff. It's not a lot of boring lawyer stuff. It's actually stories. And so people say they like stories. They don't like boring, blah, 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 lawyer, keep talking. All right. I'm the lawyer. I'll stop talking. Chris and Christina, take it away.
Thank you. Thank you, Jim. I'm going to apologize to everybody as I've just been losing my voice. I'm not sick, but I am losing my voice a little bit of laryngitis. So I probably won't do quite as much talking on this webinar, but I did want to make sure that everyone knew that what we want to try to accomplish on this webinar is give everyone an indication of what's happening in the oil and gas market. We're going to certainly hit on what's happening with the oil prices, what's happening with the green economy movement. Is there still demand for oil and gas? As well as hear from Chris. He happens to work with Mewbourne Oil Company. They're one of a couple different companies that we work with for our clients, and we determine what the best need for the client is if oil and gas is suitable for them. But what we want to highlight is what oil and gas investing is, as well as what the main tax benefits are from oil and gas investing. And these are just some of the primary areas of operation that Mewbourne Oil happens to work in. And so, Chris, I'll let you talk a little bit about just kind of what Mewbourne does. Again, you're just one of a couple oil companies that we work with, but you guys are an expert in the field. And I think you guys are like the 3rd largest private producer of oil these days.
Yeah, thank you guys very much, Christina and Jim both, and both of your respective teams. I'm envious. I'd give about anything to be in Southern California right now. If we were joking before the call, it's like 153 and humid here in East Texas and Tyler, where I live and work. But that comes with the territory as far as living and working in the great state of Texas. So again, thank you guys for taking the time. And yeah, this is a quick bird's eye view of our areas of operation. We were founded in 1965. Mr. Mewbourne drilled his first well in the Permian Basin. It was actually in Glasscock County, which is West Texas, in July of 1966. And since then, we've drilled over 3,000 wells in these areas of operation, the Permian and Anadarko basins. We have just over 550 employees. There's about 125 of us who live and work over on the eastern half of the state in Tyler, where we're headquartered, and then the other 425 are actually out in these district offices. And these are men and women who are tasked day in and day out with designing well plans, putting together trades and leases, drilling for, producing, and tending to oil and natural gas. And so We're certainly proud of our 50+ years in the business. And since our inception, we've actually grown to become the single largest privately held independent oil producer in the United States, and are in fact today the 4th most active oil company, public or private, based on rig count, running 21 rigs. So we're, like I said, very, very proud of our people, and I think that speaks volumes to our conviction in the business, both near and longer term.
Nice. Well, rig count, is this, you got it? We want to put some color in this, Christina or Chris?
Definitely, I'll have Chris speak to this.
Yeah, I mean, look, there's a lot to take away from this. And I know that you're just sitting here looking at a single chart, and a rig count to most might not mean like a whole lot. But if you really wanted to gauge what the level of activity is in our industry today, the best indicator of that is the rig counts. Christina and actually her partner and father, John, have actually been out to the field. They had a chance to join us in one of our due diligence meetings. They had a chance to go out on a rig one day, to our operations. But this is the first piece of equipment that you have to have on location if you're ever going to actually bring a well, to production. And so if you wanted to, again, look at and try to gauge, what the level of activity is in our industry today, you would look at the rig count. And you can see going back, 3.5 years, in early 2019, there was nearly 1,100 rigs running in this country. Pre-COVID, it was down to 800. At its lowest point in the second quarter of 2020, where we were all still stuck at home, you were post World War II lows at around 225 rigs. And yet here we are, fast forward to today, with oil prices at an eight-year high, and the rig count is still some 15% below where it was pre-COVID, when oil prices were at 60. And so you would think, and Jim asked a really good question before we started, which is, gosh, with prices at these levels, is everyone out there just picking up leases and picking up equipment, and is it all hands on deck? You would think that with prices at these levels, and yet there's still a relatively muted level of investment taking place in our business today. So for companies like us that have remained active, we're finding a lot of attractive opportunities, but it certainly seems like things are a little different this time around as we've come out of a price recovery, and yet you haven't seen our peers, primarily the large integrated publicly traded oil and gas companies, get back to their same level of activity that they have in decades past.
Why is that, do you think, Chris?
I think it's a combination of a couple of things, Jim. Look, if you go back to 2014, the last time you had prices at these levels, you had a rig count that was well in excess of 1,100. And that's because the majors were all running 70, 80, 90, 100 rigs apiece. There was a tremendous amount of activity, in large part due to a lot of easy money that was in the space through private equity. Not to mention, there was a tremendous amount of merger and acquisition activity, a lot of consolidation. And so you just, quite frankly, at that time had nearly $850 billion of upstream capex that was taking place around the world. And that's because you had high prices, right? And you also kind of had the initial round of the shale boom. And as such, you had market share in Saudi Arabia that was being eroded. The Saudis didn't like it. And in late 2014, they effectively pulled the rug out from underneath the price and said that they're not going to support prices any longer. They're going to flood the market. And prices went to 26 in 2015 and 2016. And I don't know if a lot of people remember that, but I bring that up only because on the way out of that, you had a lot of the large integrated companies that I just mentioned that basically were dragged in front of shareholders and told to promise this new capital discipline approach to running their business. No longer did they want them going out there and growing their reserve base at any cost in what in the past might have been well outside of their cash flow. No longer did they want them going out there and engaging in ill-timed mergers and acquisitions, only for them to find out that they basically overpaid for assets that they were never going to be able to get to, but in an attempt to try to grow their reserve base. What they wanted them to do was to express more discipline as it related to their balance sheet, and to return capital through share buybacks and dividends and so forth. So this had already kind of started, as you can see, just on the trend line coming out of 2019 into 2020. And then, of course, prices go to zero in 2020.
It went to negative, didn't they, for a while?
We're trying to forget that here in our office. They did on April 20th. They went to negative $37 a barrel, believe it or not. That was a humbling day, I think, for a lot of people. But nonetheless, you can imagine how that reverberated across the industry that was already starting to try to learn how to live within its means. And then everyone's cash flow shrinks overnight. Coming out of this now, with all of that in the rear view mirror, you have this growing, how do we want to call this, ESG, socially responsible investing, kind of green movement, where you have large integrated oil and gas companies that have now been taken and dragged back to their shareholders and back to fund managers and back to pension funds and endowment funds who are large contributors and investors in their businesses, saying, look, on top of this capital discipline that we've basically told you that you need to adopt, we now want you to start adopting some various, principles that we would describe as environmentally, socially, and governance.
Right.
And if you don't do it, you're no longer an investable business. And so what we've seen, going back to something I said a minute or two ago, is that in 2014, and this is a startling statistic, but in 2014, the amount of upstream capex that took place globally, so the amount of money that was being invested to drill new oil and gas wells around the world was around 850 billion. It's about 450 billion today. And that is in large part due to the fact that large publicly traded integrated oil and gas companies are being told they don't want, or they're being told by their shareholders that they don't want them reinvesting back up into their traditional businesses, and they want them to look 10, 20, 30, 40 years out. That, I think, is what's causing what you're looking at here.
Yeah. And so we had a question, will this apparent decrease in the rig count, will this alleviate our consumer side price or solve our trade problems? Russia, I think the question is, what I'm seeing in that question is how much of, because this is like top of mind for everyone, right? There's this war going on in Russia, or in Ukraine and in Russia, between them. How much is that? What percentage is that affecting, gas prices, oil prices, and then what can we do as investors, right, to make money on this whole thing? And I'll just kind of put that up to you.
Yeah, I mean, look, the reality of it is, you have the world's, or what was the world's largest exporter of energy, Russia, that is, invaded their neighbor. And as such, in response, most of the Western world has agreed to try to wean themselves off of imports of Russian energy. Well, where's that going to come from? Because as we're learning right now, real time, is that we cannot just transition to some other form of energy that doesn't exist in scale at this point in time. And I'm really referring to renewables in that case. In fact, Germany came out yesterday and talked about how they're in the process of trying to fire up coal-fired plants that they were in the process of retiring, because they fully appreciate that 4 months from now, when it's late October and it starts to get cold, they're going to have to figure out a way to heat their homes if they're not importing natural gas from Russia. So I only bring that up in the context of, I think the market is largely trying to figure out how much of Russian supply is no longer going to make its way to the market, how much of it can then be offset with other sources, and how much is then going to be left over in between to fill a gap that may or may not actually be filled. And what impact does that then have? And I don't know that any of us actually have an answer to that at this point in time, other than to say it's widely accepted that there's a geopolitical premium that's built into every barrel of crude oil that's traded and delivered around the world. And if it was, pick a number, $5 4 months ago, it's probably a multiple of that today because of those unknowns that I kind of just mentioned. And I guess just going back, because this is a pretty colorful slide here, if you actually try to read between the tea leaves. This is the most active oil and gas companies in this country based on rig count. And you can see there the fourth is the home team, right? It's Mewbourne Oil Company. The only large integrated oil and gas company that's more active than us today in this country is ConocoPhillips, running 22 rigs, Star 21. That's telling, going back to what I was saying a few minutes ago, in that, we've run 20 rigs before, but those guys, including Exxon, who's, further down the chart there, and Shell and Chevron and BP, would all have been running 70 or 80 or 90. So if you wanted to ask yourself, are we able to drill ourselves out of this problem that is, of course, a deficit to demand. The fact of the matter is you have 4 of the 5 most active oil companies in this country being independent. That's something that's never happened.
Yeah, it's interesting. You mentioned share buybacks. I wonder the big companies, Christina, I don't know, are the ConocoPhillips and the Exxon Mobils of the world, are they taking their capital and buying the shares back versus investing it in new production? It seems to me like that might be going on. But Chris, do they buy oil from you? Like if I go fill up, I happen to have gotten a Tesla, thank goodness, so I don't have to pay $7 a gallon. Yeah. But if I were to go to an Exxon station, am I buying Exxon oil, or do they buy from Chevron? Do they buy from Pioneer? Do they buy from you? If I go to the pump, where does that gas come from?
Yeah, I mean, so there's basically 3 different sides, if you will, of our industry. There's what's referred to as upstream, midstream, and downstream. Upstream would be those that are on the production side. Midstream would be on the transportation side, and downstream would be on the refining and midstream on the transportation, and then downstream would be on the refining and distribution side. Each one of those arms, when you look at, say, a Shell, a Chevron, a BP, all those, when I say integrated, that's because they have companies that in some regard are active in any one of those 3 tiers, if you will. I don't know that Exxon's buying production from wells that Shell drills and is operator of record on. It wouldn't surprise me if they do. But in our case, yeah, I mean, our second largest oil producer is Shell's midstream arm. And candidly, I think if you're a midstream company that's trying to get production to your downstream businesses, you're not really looking at who you're buying the production from, as long as, A, can you find it, and B, can you get it to your endpoint? And so, yeah, we don't really have a say, nor really much of a care or concern who our purchaser is, as long as it's in place.
And I think when we were there on some of the oil fields, I think Royal Dutch Shell was coming to pick up some of the well production that was in the storage tanks while we were there. So you guys have sold to some of the big companies too, as a provider.
Yeah. Right. And the reason I'm mentioning this is something for you watching this webinar, right, or this YouTube video. You understand that oil is a commodity, meaning it matters where it comes from, right? I suppose in that sense, whether it comes from Russia or the United States, obviously, it's got a different legal status. But once it's out on a ship, once it's, 1 barrel of oil is a commodity. It's just like whether it's pumped in the US or Russia or Saudi Arabia, it's going to trade at a price that is that's set by the market. So this is really interesting, because I'm remembering the number of oil wells decreased, but production increased.
Right.
Are the wells getting bigger? Are they getting more efficient? What's going on?
Yeah, I mean, if you were to say, look, for every drilling rig that was in circulation 10 years ago, it typically resulted in X number of barrels of new supply. That's certainly changed over the years, and it's due in large parts to extended laterals, as opposed to 20 years ago, 15 years ago, every well we drilled in this country in large part was drilled vertically, and you fracked it with a single stage frack. And then, of course, would have to go out and basically chase these channels and trends over the course of an entire section. You might drill 15 or 20 or 25, vertical wells, and it was kind of a game of averages. What you do now in the business is you're drilling horizontal wells where you still drill the vertical section, then you kick off and you go out a mile. What would have been a mile maybe 5 years ago to what was maybe 2 miles a year ago, and now in some cases you're going out up to say 3 miles. And the reason I bring that up is what one well produces today is a multiple of what one well might have produced 10 or 15 years ago. So yes, despite the fact that maybe fewer wells were being drilled over the course of the last 6 or 7 years, supply was in fact growing. Where that all changes is it goes back to what we've talked about in terms of just the total amount of investment taking place in the business. And I think this chart does a good job of explaining that if you don't have the investment, it's very difficult to grow it. And if you look at what took place in the preceding years represented on this chart, you at least had a relatively stable amount of investment taking place versus a relatively dramatic decline that's otherwise taken place in the business today. And the end result is that you went from 13.1 million barrels a day in March of 2020 to 11.6 or somewhere around like that today.
Yeah, and what's interesting is if you look at, this is the time that the Democrats have been in charge of the White House. And people say, oh, well, I'm voting one way or another because of energy policy. And I talk to some people and they say, oh, well, I vote for this party because they're pro clean energy. We're pumping more oil now in the US than we were when Joe Biden became president. Right. I mean, and I'm not saying this politically, I'm just
I get it.
this issue of the oil production is favored by the US government, regardless of party affiliation. And that's the point I want to make. So,
Yeah, no, I think it's fair. I mean, I would argue that, under certain administrations, you can probably assume what party I'm referring to. There's probably going to be more regulation, and under other administrations, there's probably going to be less. And I'm not simply trying to pick a side, but you're right. I mean, look at what's happening right now as we approach, midterm elections in the fall. And I think any sitting president or any sitting senator, regardless of party, would know that high prices are not necessarily something that benefit you as a congressman or woman, or as a president, or anyone else that's actually coming up for re-election. And so, yes, undoubtedly, I would say at its core, oil and gas development is something that most people, at least behind closed doors, would probably champion.
And you guys, I know that Chris, with your company in particular, because you guys are primarily focused on the Permian Basin as well as Anadarko Basin, it's primarily Texas, but also Carlsbad and Hobbs, New Mexico. And you're dealing with two different opposite political climates in both states.
Right.
And so you guys are used to working with both parties, different political parties, different administrations for decades. This is not a one party versus another. This is something that's a necessity for U.S. energy independence.
Yeah. Look, you make a good point, right? I mean, New Mexico is a very good example of this. The southeastern part of the state politically votes very differently than the central and northern part of the state, where the capital obviously is. But I think the people up in Santa Fe and Albuquerque all recognize that in terms of their state revenues, something like a third of it comes directly from the oil and natural gas business. And I believe it's something like close to 70% of all of their recurring spending at the state level comes from revenues derived from either directly or indirectly from the oil and natural gas industry. Think teachers' salaries, think roads, schools, things along those lines. And so it's a delicate balance that I think everyone has to weigh, but we keep a very good working relationship with Governor Littlejohn in the state of, Lujan in the state of New Mexico. Certainly want to make sure that we have a voice and a say in any rules or regulations that they're proposing. And then most importantly, are going to abide by whatever rules they do in fact pass as well too. We have no choice but to be a good steward of the areas that we operate in, and that's just how we've run our business for 50 plus years.
Well, let's talk a little bit about. I think we've talked about supply and demand. Is there any color you want to put on this slide here?
Yeah, I mean, I would just say that, even going into this year, it was widely believed that we were going to be operating at a deficit to demand because, as the global economy opened up, demand returned a lot faster than people expected. What this chart didn't pick up and forecast was that Russia was going to invade Ukraine. And going back to what we talked about a few minutes ago, that you were going to have a substantial amount of supply that's potentially no longer making its way to the market. So I think you could probably argue that your world production, that blue line, is probably back below the greenish line, hence why you've got prices at $100+ a barrel.
Yeah, I remember I took a macroeconomic course in college and I learned the concept of vertical demand, and the example they gave is oil. And you need oil to live, right? Even though we might want to not be dependent on oil, we are today.
Right.
And that's why the price spikes, because you can't really reduce. It's very hard to reduce your consumption. You still have the same drive to work, even though you're spending 5 times as much. We had one of our assistants filled up her pickup truck. She got 2 tanks. It's a diesel. What was it? $250, she said.
Unreal.
$50 to fill up a truck.
Yeah.
Crazy.
Yeah, in California, we're suffering from a little bit higher prices than Texas, I'm assuming.
Just a little.
Yeah, no, I get it. Look, I mean, I've already kind of mentioned this, but yeah, this just kind of looks at the CapEx as well too. It's just part of the broader story. I guess if we were to take one thing away from this, and then we can shift gears if you guys would like, and obviously talk about anything, but if we take one thing away from all of this, guys, it's that, you know, before Russia invaded Ukraine, oil prices were headed higher. They were already in the high 80s. And then, of course, they do invade and prices spike and haven't really gone below $100 since then. And I bring that up only in the context of there was a legitimate concern that supply was not going to be able to meet global demand. And that, again, has really only been exacerbated because of everything that's taken place over in Eastern Europe right now.
I'd like to see a graph of share buybacks and investment. That would be interesting because I think that's what's happening. Anyway.
Yeah.
So this is the price of crude that went negative and it's going up, right?
Yeah, I mean,
up.
What's the forecast, Chris? I mean, I know that for a period of time, I mean, I know I've been working with a lot of oil and gas investments for years. And I think in the 2016 to 2019 era, every economist was saying we're range bound, $55 to $65 a barrel. We are range bound and we are pretty well in that range. And again, we haven't seen these kinds of prices in a long time. So what's kind of the forecast?
I mean, if you go out on the futures market, and you go out 2 or 3 years, it has prices in the high 80s, I think, or at least when I last checked. So I think there's some hope that the situation in Eastern Europe resolves itself in some period of time, at least within the next couple of years, and that there can be some balance thereafter. And as that happens, that demand, despite the fact that it may continue to grow, is at least able to be met with some additional supply that would come online here, domestically and potentially in other parts of the world as well too. Look, the $1 million question, of course, I think is really when do the large integrated oil and gas companies get back involved again? Because candidly, we can do only so much pushing. Companies like ours, the ones that really and truly move the needle are the Exxons, the Shells, the Chevrons, the BPs, and the ConocoPhillips. And when you have Exxon report their first quarter earnings and almost glowingly say that their production fell 4% year over year, that they were increasing their share buybacks, they were increasing their dividend, and that they made something like $4 billion in investment in renewable energy, that's fine. I have zero issue with any of that. But if that's going to be indicative of how they're going to run next year and year after that and year after that, then it doesn't really change the hypothesis with regards to this lack of investment taking place in the business today. And I would say in the grand scheme of things, that's probably a net positive for prices. Meaning
that they would go down or stay up?
I would think they probably could stay elevated if that does in fact happen. I think, look, that you either get more supply online, and that's going to be difficult to do for a host of reasons, labor shortages, supply chain constraints, obviously budgets that are somewhat more constrained than they have been in decades past, or you have to have demand come back in line with supply. And I think that happens if you see a global economic slowdown, which is always potentially in the cards, and maybe it's even closer to happening now with already a first quarter negative GDP print. But again, I would say on balance, as long as global economy continues to grow and expand, and as long as there's a lack of investment taking place in the business, that's probably a good thing for price in terms of whether it's $80 or $100.
Chris, I wanted to make sure that we focused on the green economy, as there is a move to have more ESG friendly investments. And I want you to speak to this with a little bit more. On the next slide, we'll also kind of talk about how your company is environmentally friendly and how you drill and things that can be done. But as we have this move towards electric vehicles and wind and solar, I mean, there's still oil and petroleum for airplanes, jets. It's in deodorant. It's in the production of electric vehicles. It's still going to have a high demand for oil and gas. But if you could give us a little more clarity on this, that'd be great.
Yeah, I mean, look, the reality of it is there's clearly a transition taking place today, whether you look at, electric vehicles, whether you look at just the power grid as a whole, 10 years ago, Tesla at that point in time, I think it was 2 years removed from delivering their first car, and there were 50,000 of them on the road, maybe. I mean, you saw one and it was like seeing like a white buffalo when you went to Yellowstone. Now you see them quite routinely, but it still only accounts for 4% of the overall market share in this country. It's 7% globally, but that speaks to what's been some explosive growth in that space. The same thing is true in power generation, specifically. If you look at the electricity grid in this country, today I think something like 12% of all electricity that's generated is from renewable sources, and that was 2%, 3% 10 or 15 years ago. So again, it's spectacular growth, but we're still talking relatively small numbers, relative to the overall size of where demand actually is. And I think the thing that's even more incredible about that is if you go back to when Tesla delivered their first vehicle in, August of 2008, global oil demand was 85 million barrels a day. And you fast forward to today, and there's millions of Teslas on the road, and there's millions of other electric vehicles around the world, whether it's NIO in China or the large legacy manufacturers here that are in the process of making billions of dollars, tens of billions of dollars in investment to build out their electric vehicle fleets, and yet global oil demand's at 100 million barrels a day. So I mean, we haven't really been offsetting any of our demand with electric vehicles. It's just the global economy continues to grow at a faster clip than we're able to displace an internal combustion engine. So what I consider renewable energy is a threat to our business. If you want to have that conversation in terms of decades, we can have that, and I think you have a legitimate argument. If we're going to talk about it in terms of days, weeks, months, years, inside the next 10 or 15 or 20 years, I think you'd probably struggle to convince me.
Well, maybe if we can talk about something that's going on with legislation, and put some context on this. I think, is this Christina? Is this your slide or is this Chris's slide?
I think that this was, I don't know if it was a combination of our two, but definitely wanted to just speak to, increased regulation. And you hear about, closing leases or having federal land leases available. But I know in your guys' case, you guys don't drill on much federal land. It's all private to my knowledge, correct?
That has been the case in some cases. No, I mean, we have a substantial amount of activity on federal lands and specifically in Southeast New Mexico. There's not really any in Texas, and there's some in Oklahoma, but it's not areas that we operate in. But no, we drill a material amount of or have a material amount of activity on federal lands in Southeast New Mexico.
What do you guys see as far as pending potential legislation or regulation that could hinder or make things difficult for Mewbourne?
Yeah, I mean, look, if you look at just the underlying narrative that comes out of Washington, I think it's pretty clear that they do favor renewable sources of energy versus traditional fossil fuel sources of energy. And they were very clear in communicating that on the campaign trail, so it didn't really come as a surprise. They were probably a little bit more aggressive with a few of the executive orders that they had signed not long after taking office. A few of those have been challenged and have been struck down. But at the end of the day, I would say that, it's a little bit more difficult today to operate on federal lands than it might have otherwise been, 2 or 3 or 4 years ago. I think the bigger question now is that as we've seen higher prices stick around, is when now you're hearing this discussion of windfall profit taxes and stuff like that. So far as I've read, that's really something that they're trying to target. Again, the larger publicly traded peers, not really the independents. But those are all things that probably do the opposite effect. If you're trying to spur investment in the business, I don't know how it is as a CEO of Exxon, you could get too excited about, signing off on a project that might take 4 or 5 years to bring to fruition. And also be told in the same breath that, you're going to have to pay windfall profit taxes on your, on your profits. So, who knows? But yeah, look, all of these things, when you kind of mix them all together, I think can lend themselves to some discussion as it relates to just some of the tax sensitivity with regards to, our business.
And I did want to hit on just, I know various companies do different things to be environmentally friendly. And I know that having witnessed some of the well production and how your company operates with respect to being environmentally friendly, there's quite a bit of going out of the way to make sure that you're as environmentally friendly as you can be. And in the Permian Basin, it's very brackish. It's very, it's a saltwater bed where there's no water tables to potentially contaminate water supply. However, I know that there's a lot of water that's extracted whenever you're extracting any kind of oil. And that being that it's salt water, there's still some things you guys can do to dispose of that water and use it for desal or recyclable water. So can you speak to that just a little bit more?
Yeah, I mean, for sure. There's kind of a long backstory to it, but the short of it is, as a company, we produce probably 500,000, in some cases, barrels of water a day. It's produced water. Some of it's just water that you would encounter in these formations, and a lot of it is, water that you actually introduce into the formation as you go in to stimulate these wells. That's going to flow back, typically as the well's brought online to production. But in the past, you'd go in and effectively take this water to an injection facility, or what's referred to as a saltwater disposal well, and inject it into a formation that would accept it, and the state, obviously gave you permission to. There was obviously a cost associated with that, but environmentally, when you look at the impact that just basically using a barrel of fresh water for single use, you started thinking that there had to be a better way. And so, yeah, we've made a sizable investment now that's probably north of $150 million that is in various water reclamation and treatment and recycling facilities where something like north of 80% of all of our produced water is being reused back on future jobs. And so clearly that was probably motivated by the economics, but it's the right thing to do by the environment as well. So yes, no question.
And then what's the LDAR training employees? I'm not sure.
Yeah, LDAR stands for leak detection and recovery. It's effectively going through and training our well tenders and pumpers to have a better idea and understanding of various leak detection and recovery methods. That way you can be proactive as opposed to being, reactive with regards to any sort of methane release and things like that.
Does everyone do this or not? Is this kind of industry standard?
I would like to think that we're at the forefront. The industry's certainly playing catch up with regards to the water side, although they're catching up, but not everyone's doing it. If for no other reason, you have to have the money, the capital to be able to do it. So there's limits to it from that consideration. In terms of retrofitting facilities to modern specs and aerial surveys and things like that, I think that's becoming more standard. And going back to the discussion about New Mexico, they now have the strictest methane emission laws in the country, and I think they'll probably be adopted at the federal level. And we've certainly been industry leading in terms of where our emissions numbers come in relative to the industry, to the point that I think something like 99.5% of all of our gas production is actually sold downstream. So very little, if any, is actually being flared.
Well, it's interesting that you mentioned the fewer chemicals and fracs. It's like with farmers and fertilizer. They want to use the least amount of fertilizer possible because it's really expensive. And I know because my uncle was in the oil services business before he passed away, and that acid is very expensive. That's a big capital outlay. So yeah,
no question. It's predominantly water and sand at this point.
And I kind of put this illustration together, and it's because it's very hard to describe this to someone, and it was described beautifully when I went out to the oil fields, and I think in Carlsbad or Hobbs, New Mexico, and was able to be explained by actually some of the people that operate the rigs as to how the fracking process works, because you do hear a bad rap. There's been the Hollywood movie about fracking and drilling, and does it contaminate, the water table. And I think this visual was really helpful for me, that when they're drilling with about a 10, I don't know what the diameter, what's the original diameter that they're drilling vertically, Chris?
Oh, gosh. I mean, your surface hole is 37 and a half inch probably.
Yeah, so you've got this huge, drill that's going down, but then they're filling it with quick concrete to create a barrier, and then another barrier before you actually have any of the oil that's coming up. So if there was anything that leaked in the oil coming up, the oil and gas and salt water that's coming up from the drilling activities, it would hit a concrete wall and not contaminate into the earth. And that was fascinating. So I'm probably not doing it justice, because this isn't what I do on a daily basis. But if you want to add anything to that, that was impactful for me.
Yeah, for sure. Look, we have, like I mentioned earlier, 425 plus employees out in these areas that we operate in. And outside of the oil and gas industry, they're agricultural based. And so, fresh water is their lifeblood. The idea that someone would knowingly go out there and pollute the fresh water table just so they can, impact an entire community that they live in is just crazy to me. But I don't know that people really care to hear that. So, what do you do, I guess, to try to maintain the integrity of your wells? So you're basically preventing any sort of seepage or contamination of whatever fresh water table may exist. And so, we know, and in some cases, you actually have to submit your plans to the state, and they tell you exactly how you have to design your well. But there's basically 3 layers of steel, and which is referred to as casing, steel and concrete, as you're going from a larger hole to a smaller hole to a smaller hole until you get down in your curve where you're producing out. That's actually down to 5 7/8, I think, is what it is now. But you're 7 inch on the curve. That's beside the point, I guess, other than to say, like you were suggesting, that it would be very difficult for any sort of contaminated fluid to make its way through that many layers of steel and concrete. And in addition to it, I mean, we run sensors and things like that monitor pressures. So you'd have a really good idea if you did have a crack in your casing and you were losing, X percentage of pressure, you'd be able to identify that rather quickly as well too. So I think again, the rhetoric as it relates to that is probably been largely incorrect.
Well, all this sounds really, really, really expensive. So how do you guys raise money for this? How do people in your industry raise money? Maybe we can segue into kind of probably why a lot of people are watching this.
Yeah.
I mean, look, we're fortunate that we spend and invest within our cash flow and have since our inception back in the 60s, but we do have a little bit of outside capital that participates directly alongside us each year in our drilling program. And, I guess at the onset of this, you were talking about some of the benefits or potential benefits. And one of them that I know Christina can speak about as well too is there's some very generous tax benefits associated with this type of investment. And for those of you that are in California that have the benefit of paying 40, 50 plus% of your income to the state and federal government, there's fewer and fewer things that you have that you can help reduce your taxable income, and this is one of those still. So the IRS allows you to deduct all costs associated with drilling an oil and gas well, as you'll see here, that are considered non-salvageable or intangible, and that's typically 75 to 80% of the overall well cost, and it's an above the line deduction. So again, you could take it against your W-2, your 1099, self-employment, capital gain,
R&D, required minimum distributions,
Roth IRA conversion, any of those things. If you have passive income, there's actually the ability to take it against passive income sources as well too. So yes, given that there's a cap on what you can utilize for mortgage interest against your federal income and state income against your federal return as well too. This again is one of the few things that's still out there that gives you the ability to generate that above the line deduction. And again, it's all because of what's referred to here as the intangible drilling cost.
Yes.
Chris,
Yeah, I'm sorry, just to sort of give, for if you're watching this and you're like, I don't understand what these people are saying. Here's what this means. You put in $100 and you're going to pay less income tax, and it's going to depend on how much tax you're paying in your tax bracket. But that $100 is an investment and you're getting a return on that investment. And it is dependent on, is it dependent on the individual production of the well? Are you aggregating wells? Is it dependent on the price of oil? What are some of the variables, if you can maybe, put?
Yeah. So yeah, we don't just do a single well drilling program. I mean, it's going to vary each year based upon, our cash flow. But for 2022, for instance, it's, probably north of 300 wells. But yes, in our business, your return is going to be driven by your cost to drill the well, the production you get out of that well, and what you sell your production for. That's going to make or break you in our business. So you want to drill wells for low costs, you want to prove up your reserves, and you just want to hope that oil prices take care of themselves over time after that. And, if you can do those things, we found that you could be successful more often than not.
And Chris, the IDC deduction, the intangible drilling cost deduction, which is the highest, it's a deduction against your highest taxed income. That's something that's been in the tax code for a long time.
Yeah, it has. It's not new. I don't know if it's, I think it might be the 30s or something like that, but it's 469C, I believe, is the section of the code. It's referred to as the non-passive working interest exception, which would allow you to take that loss as a non-material participant in the business against your other sources of income. But yes, it is not new. It is something that's been around for some time. There was an attempt last year to put it in some of the initial drafts of that Build Back Better bill that is effectively all but dead at this point in time. And so as it stands today, there really hasn't been a whole lot of discussion with regards to making any changes to the various tax treatments and tax benefits associated with our business.
Yeah. And the other allowance, which is the depletion allowance, if you will, which shelters some of the income that's received. So kind of a quick analogy, and then we can open it up to questions and wrap it up. That would be, if you invest $100, you're going to get a tax write-off over the course of typically 2 years, sometimes 3, and you're going to get a tax write-off in the neighborhood of 75 to 80% of what you initially invest. That's a tax write-off. Right. So that's an immediate tax savings. But then you also get of a royalty income stream. Typically that royalty income is going to last 15 plus years of a
working interest, not royalty, but working interest income. Yep. Working
interest income, which means you're going to get income off of the oil and gas well production and whatever. And it's largely determinate based on the price that's being sold into the marketplace. So it will fluctuate as far as that income will go up and down based on the price of oil. And typically it's bell curved, if you will, where there's kind of a peak of that well reserve production. When does that typically peak out?
Yeah, you make a really good point. I mean, if you draw just your typical bell curve, that's probably in part kind of what your revenue is going to look like for some period of time. As you're bringing on additional production, you would expect your revenue to grow. And then because of the inherent nature of an oil and gas well is that it's a depleting asset, as you're no longer bringing on any additional supply, your production is going to fall. That tends to be a relatively hyperbolic decline in the early stages. Could be north of 60 or 70% year over year in the first year or two. And you would expect your revenue to reflect that as well too. You'll get to a point in time where the decline curve isn't near as steep as it was in the early stages. But yes, sometime probably outside of maybe year 3 is where you would expect your revenue to plateau and then continue to decline thereafter. And it's not uncommon that you maybe produce 50% of your expected reserves in the first, say, 5 or 6 years of a well. But yes, we would expect these partnerships to last probably 12 to 15 years.
Perfect.
And then so on this intangible drilling cost deduction, Christina, and Chris, when is that taken? So if somebody puts in $100 this year, are they deducting $100, 75 or 80% of $175 or $80? Are they deducting that from their income, or does that spread out over a period of years? What does that look like?
Yeah, and it depends on the company and the partnership, whether we're working or investing with Mewbourne or another oil and gas company, because each one's slightly different. But typically over the course of 2 years, it's going to be somewhere in the neighborhood of 75 to 80% in total. And so if you invest in this year, you might get 20% this year. So if you invest $100,000, you're going to get $20,000 right off this year. And then you might get the rest of that 80% next year. And then of the cash flow, I think what's really important too for clients to remember, and that's really where we help analyze the client's needs, as to where an oil and gas investment, if appropriate, might work for the client. But some companies are more focused on taking that tax benefit up front and not seeing as much of a cash flow as quickly. And some companies are more cash flow oriented. And the important thing to know is, of that cash flow that's coming in, for every dollar that's coming in, Chris, how much is sheltered from taxation due to the depletion allowance?
Yeah, it's a 15% gross once a property is outside of a loss position. So that's a nice little added benefit on top of the IDC.
Perfect. So I think, Jim, you have a couple questions.
Yeah, we have a few questions. So this is on our YouTube page. Please check. If you have not checked out our YouTube page, we have well over 100 videos on there. We take deep dives into all kinds of different topics. Go ahead and subscribe to our YouTube channel and share this with somebody if you think they might benefit from it. And maybe we can talk about this. Who would benefit? By the way, if you'd like to reach out to our firm, you go to our website, you click request an appointment, review us on Google. Here's your contact information. So for those of you who would like your contact information, we'll leave that up as we go through the questions. But so if somebody says, hey, this sounds really cool, I'm making, we have a lot of clients that are high W-2 earners, and it's not uncommon for someone to make, 200,000 or $1 million a year as a W-2 earner, right? And sometimes you might have two people. It's, we have a lot of clients in the tech space, and a lot of times a husband and wife are both working, they might be making 600,000 each. There are very few deductions. And for those of you who are high W-2 earner, you know exactly what I'm talking about, because you go to your accountant and you're like, well, what do I do? How do I save taxes? And they just kind of throw their hands up and they say, not much, right? So maybe if somebody knows they're going to be making 500,000 a year, let's say, for the next 3 or 4 or 5 years, Christina, how would you approach this if somebody said, hey, this is interesting to me? Should I be doing this every year? Is this kind of a one and done? Maybe kind of unpack that a little bit.
Yeah, most of our clients that have been doing Mewbourne for years are repeat investors, and they do it a little bit every year. Because the IDC deduction takes place over the course of 2, sometimes 3 years. Let's just say you get a 15 or 20% deduction in year 1, and you get a 55 or 60% deduction in year 2. If you do a little bit each year, then you're kind of riding a wave of a higher deduction. And so that's important. And then a lot of our clients do this if they have very large required minimum distributions, or they're also, again, high W-2 earners, and then they're looking at setting themselves up for retirement. A lot of the income that comes in from an oil and gas investment, they'll look at redeploying that in towards another oil and gas investment. And then maybe when they retire, they don't need as much of a tax deduction, but they want to collect a tax efficient income stream. And because if they do multiple partnerships leading up to retirement, they're going to have multiple years of kind of a bell curved plateau at different stages of tax efficient income in retirement. So it really depends on the client as to what's suitable for them, but most clients do a little bit each year. Now, I know, Chris, I'll pose this to you because I think with some oil and gas, I'm sure with you guys, with your company, some oil and gas investments have performed so well over the last couple of years that they're kicking out so much income that we're using those allowances for the deductions so quickly. And people are going, oh my gosh, I'm now having so much income coming in and I don't have as much offset because we're getting so much income so quickly at a high price. And I think that that's the good and the bad is it's, you want your quick return, you want a really high return investment.
Right.
You can't, I guess sometimes you can't have your cake and eat it too. You're going to pay.
It's a good problem to have, right? But
no, for sure. Right. I mean, at the end of the day, you're in this to make money. But you know, the income is taxed. And so a portion of the loss that you generate in the second year is most likely going to be used to help offset some of the income that's generated here. And if you only have income equal to 10% in year two and you got a 60% loss, then of course you have a net 50% you can use against other sources of income. But if you get 40%, you know, income in the first year, and you still have that same 60% loss, then you have 20%, you know, of the initial investment that you can go use against other sources. So you're exactly right. It's a good problem to have, but I appreciate you know, where it's coming from.
I think the other question we had, Jim, is I think a lot of these questions we've already kind of addressed, but there's one question that spoke to when pumping oil, is it conducive to earthquakes, or is there any technology going into the pump? We talked about the water. We talked about water with drilling.
Yeah. So,
but is there, you know, typically areas that are being drilled for oil are not earthquake or natural disaster sensitive areas in general.
Yeah, look, I mean, you're obviously drilling a hole, if you will, into the earth, and you want to be mindful of the geology that you're entering, which we are. There's been some discussions in the past about whether or not fracking has been the root cause of increased seismic activity in certain parts of the country. And what they've determined through endless studies, both public and private, is that it's not the actual hydraulic fracturing itself, but it was, going back to the discussion around water and produced water and having to inject water, is that there were some injection wells in certain parts of this country. Oklahoma was a hotbed for a while. Ohio was in part. West Texas has been in the conversation, where they basically were overpressuring some of these zones. And in some cases up in Oklahoma, they were injecting into an area that actually had some existing faults. And so it was probably a part of it, the disposal of water, as they've shut some of those wells in, or they've greatly reduced the amount of water they're allowing to inject. It's reduced the amount of seismic activity materially in those areas. And so it really wasn't in the operations of drilling or fracking the well, it was on the disposal of water. So they seemingly have a lot of that, I think, under control. And I hate to cut this short here, because I certainly enjoyed the conversation, guys, but
I think we all have to run.
Yeah, so just
I have to jump
if you need to hop off, Chris, that's okay. Just a couple of questions that I think Christina and I can answer. Valerie says, hi, Jim. Thanks for offering these insightful webinars. You have a lot of office locations. Which one can I schedule an appointment with you personally at? Do you do Zoom appointments? Yes, Valerie. Thanks, Chris. Yes, I do Zoom appointments, and I also do travel to the offices to meet in person, but many of the people I happen to meet with are on Zoom because I'm primarily in Northern California and Christina is primarily in Southern California, but we go back and forth, both of us do. Jeff asks, what is a typical investment amount, and is there a minimum required investment? Christina, what are you looking at?
You know, the investment size ranges all over. I'd say the average investment that we see is about 100,000, but we have clients that do 50. We have clients that do 250. We have clients that do less. The minimum investment's typically around 20,000 typically.
Okay. Richard asks, I have a lot of passive investment income and previous real estate and stock trading losses. How would this investment help me?
We probably have to talk to you a little bit more to see if passive versus active, what kind of tax, situation you're in, and analyze the tax return a little bit. So
I think actually that's a great question, Christina, because if you're watching this and you're saying, I don't know if this is right for me, this is why you need your A team. This is why you need somebody like Christina, somebody like me to meet with you and your CPA. So that's the third leg of the stool, if you will. But it's really important because there is no one size fits all. And I think it would be foolish to say, oh, everyone should get this. It's like, everyone should drink 8 glasses of water a day or whatever. I think it's foolish to say everyone should do this. It's individual. That brings us to the end. Christina, thank you so much. Thank you for watching.
And Jim, I'll just mention, that is where we do have a team. I have a team, you have a team.
Right.
Our team is certified financial planners only. So whether it be myself or one of my other 2 or 3 business partners, we can analyze whether this is suitable for you. Most of these types of investments are fairly time sensitive because there's a limited amount of capital that they'll raise each year to participate in any one of these partnerships. So if it's something of interest, it is fairly time sensitive.